welcome back. And thank you so much, Anne-Marie and the panelists, for such a thought-provoking debate on particularly in such a hot topic, fresh off the press from Friday. The situation had changed. And it was really insightful to hear that, the government really needs to work on the infrastructure and really finding ways to make sure that this whole process is actually executed, professionally. And it was also insightful to hear that we need to involve people across the board, especially in decision-making, right down to the rural areas. And then, of course, also making sure that, assets remain at the hands of the people who truly understand, socioeconomic challenges. I think that was really insightful, and it was really good to see the balance of different opinions as we go into that conversation. So now you all came into this room to really talk about the business case. Now I'm talking about the business case, the rationale for investing in Southern African private equity. And, there was research that was released just early this year. And it basically said that, if you're looking at the global venture capital investments, overall, during the fourth quarter of 2020, that research is saying it actually remained robust, right? But when you look at our region in particular, there's been an interesting case. I mean, the returns, it's been difficult. The political and economic uncertainty is really affecting investor appetite. And even the deal pipeline, the slowdown, remains. Despite all of that, if you look at performance-wise within the industry, there has been some winners and there has been some losers, right, getting into 2021. And it'll be interesting to find out who ended up being on what side. It boils down to some of the decisions that you made last year to make sure that you become more sustainable. So I'm sure we're all excited to learn. So what is really central in the business case and what would be important, particularly looking at the Southern Africa region? So what's going to happen is we have a panel of experts that's going to be led by Natalie, Kolbe, and they'll be having a good discussion on this. She's actually a partner at Actis and is responsible for their investments in Tracker. She has a Bachelor of Commerce from the University of Witwatersrand and also an MBA with cum laude, by the way, very impressive, from the Business School, and is a CFA charter holder, as if that was not impressive enough. And so very excited to hear the conversation, and I encourage people to use the hashtag SAFCAConf 2021 and SAFCAPEConf 2021. Let's have the conversation. Over to you, Natalie. Thank you.
Thank you, Zipo, and thank you for that very elaborate introduction. As Zipo said, the topic that we're going to be speaking about today is the business case for investing in Southern African private equity. And I'm very lucky to have a very esteemed group of people to help us with that discussion today. Needing no introduction is Runa Allam. I think most of us know Runa. She's the co-founding partner and CEO of DPI. We have Jan Ingi, who's the Executive Director of Intercontinental Trust. And we have Vuyo Ntoi, last but not least, the Joint Managing Director of AIIM, which stands for Africa Infrastructure Investment Managers. So look, this topic of the business case for investing in sub-Saharan PE is one that comes up at every SAFCA conference in one guise or another. And I think, Zipo highlighted the elephant in the room, which has been returns. The history of returns in private equity has not been at the level that a lot of the investors would have been hoping for. And now we've had a new bump in the road called COVID, which will certainly have some impact on returns. So, Runa, if I may start with you, should we be worried? Is it all doom and gloom, or are there some bright areas of optimism that we can focus on?
Thank you, Natalie. I think we should be worried, but we also should be optimistic. So yes, COVID is a bump in the road and a big bump in the road. So if you look globally in COVID, Africa as a continent has done well. 100,000 deaths, sad, yes, but 1.3 billion people. Unfortunately, though, South Africa has had half of the infections and half of the COVID cases. So that is worrisome. The new variant is worrisome, and the impact of that on restrictions in the economy and the performance of the companies. So that just needed to be said. I am actually quite optimistic for a number of reasons. On the COVID side, there are new vaccines, and however bumpy the road is in vaccines, we will get there. The COVAX initiative is bringing in vaccines to Southern Africa, to Africa in general. South Africa is buying vaccines itself. So that is one. Two is there is, even within COVID, a lot of resilience shown by many of our companies. So you talked earlier about, what to be optimistic about. 70% in our portfolio of the companies were declared essential companies. So not only did they not close, they could not stop trading. None of our companies actually stopped performing, stopped being in operation. And by the second half of last year, most of our portfolio was back to growth. And I see this pattern repeating throughout Southern Africa over time. If the fund manager and the companies took early steps in having a COVID committee, reacting quickly, health and safety, supply chain, cash preservation, then we've had a year to work on it. And I'm seeing many companies essentially, being in that position where they can finally look to operating, to having some growth and some profitability. So I would say Africa has been, despite all the problems, has been extremely, extremely resilient. And some of the resilience comes that, and I remind everyone that actually the fundamental business case in investing in Southern Africa hasn't changed. The demographics are still young, and they are still leading to productivity within the economies. Urbanization is still high, so companies that sell can sell in particular regions, which help with margins. The technology case, within COVID, that has even changed and gotten better. One of our companies, Lashego in Botswana, went from 2% online transactions this time a year ago to 70% today. So if anything, putting in technology has speeded up, and that will help our companies and our industry not only now, but into the future. And finally, if you look at the commodity cycle, from copper to oil, it is turning, and that will help all of Africa, including Southern Africa.
Great, Runa. That's a comprehensive list, and certainly gives us reason to be optimistic. Jan, if I can turn to you, I mean, you are a fund administrator based in Mauritius, and that certainly gives you a very privileged position of sitting as a director across a lot of different companies for different fund managers. What are you seeing with that bird's eye view? Which sectors are your most successful fund managers investing in?
Okay, thank you, Natalie. So I think, first of all, I was very impressed at the speed at which fund managers adapted to the COVID-19 situation. That was done very quickly, and I think well done to all the fund managers. So I think at the beginning it was survival mode, and no sector really emerged. But as time went on, as people were working from home, lockdown, we saw some industries doing better than others. And I think that the first one is food security. So when people were on lockdown, I think that was the biggest worry of people on how they would get access to their food. And I think what happened is at the same time, some countries were restricting exports. So it was getting more difficult to import food. Then a lot of countries or even companies realized that food security is extremely important for a country. And that sector, therefore, emerged. We have seen a lot of companies investing in those food-related industries. So in the manufacturing, storing, and distribution of food at a larger scale. So I think this is a growing sector, being food. I think the second one is the import substitution industries. I think because imports were getting more and more complicated, because a lot of the countries in Africa, there was depreciation of the currency and the higher cost of freight. The higher cost of imports meant that if you could produce locally, it was much cheaper, and there was definitely a potential in those import substitution industry. I think the third one is telecommunication. So since I think work from home has become the new norm, reliance on communication, providers of internet, cloud and data centers, etc. So demand for their services increased overnight with the COVID-19 situation. I think that industry is doing extremely well. And I think I've seen some buyouts on those for which the returns were phenomenal. And I think that the last sector I would like to touch is on the fintech. So people staying more at home, there was the growth in e-commerce, cashless apps, more video conferencing being used. So I think all those sectors in the fintech that can help people being more efficient by being at home, this fintech sector is definitely growing.
Thank you, Jan. That certainly is it's a great summary of those sectors that, from a consumer perspective, are really taking off. Vuyo, if I can turn to you, I mean, obviously from an infrastructure side, the sectors would be very different to what that you'd be looking at. What are you seeing from an infrastructure side as to where investors can focus on to be making decent returns?
Yeah, thanks for that, Natalie. I think our take on this, and I think one thing that's worth highlighting is that infrastructure investment is not monolithic. It includes very different sectors. It includes energy investments such as power and renewables, midstream energy. It includes transportation, roads, airports and ports, etc., as well as PPP projects. And these are projects that exhibit very different characteristics in times of stress. However, I think what is key on these projects is the fact that they're risk mitigated because they have contracted revenues on the main. And I think what we believe is that infra is a risk mitigated entry into emerging PE markets such as sub-Saharan Africa. I suppose Southern Africa itself is probably a bit more developed, but might still be seen as emerging by other players. So I think the thesis remains the same. Yes, COVID has led to some pressures, but we believe that as Runa mentioned, the fundamentals around the need remain unchanged. In fact, in some instances, are even exacerbated. So we believe that investments into energy, South Africa's struggling with load shedding at the moment, is an area that lots of investment is required. Renewables are in high demand at the moment, given the various initiatives to reach net zero by the middle of the century. We believe midstream infrastructure is going to be attractive going forward as the likes of gas become a more meaningful part of the whole energy value chain in Southern Africa. Transportation, roads, airports, ports, those will probably need to be expanded over the near to medium term, which obviously provides a great investment opportunity for investors who are looking at those risk mitigated sectors. Yes, there's been COVID and there could be changes in behavior, etc. But what we've seen, though, on some of our toll roads, for instance, is that some of the more trade-related demand areas, i.e. heavy vehicles on our toll roads, those have pretty much gone back to pre-COVID levels. So again, I think there's a lot more resilience in the arterial infrastructure that's required in a country, and you see less elasticity than you'd see in more consumer-focused sectors.
Thanks, Vuyo. And I think just to add to what Vuyo was saying, I think one of the outcomes of COVID is going to be that government coffers around the continent are having been emptied out from having to support COVID related projects or rollout of vaccines, etc. And I think that's going to create quite a nice opportunity for public-private partnerships, particularly in the infrastructure space. I mean, Runa, maybe just turning back to you. I mean, certainly we've spoken about the some really interesting themes that are coming through, and some that are potentially new or emerging. I mean, certainly, Jan spoke about the digital infrastructure space, which, although it's not new, it certainly has got a boost this year. And then you mentioned how a lot of companies are turning towards tech enablement to leapfrog some of the older industries that are there. But we've spoken about sectors and about these tailwinds. But is that enough? I mean, we can all kind of say, okay, well, look, these are the sectors that are growing. As a fund manager, I'm going to focus on those sectors. But that only gets us halfway there. I mean, what, in your view, what distinguishes to really ensure that you as a fund manager can get decent and good returns that the industry is hoping for?
Thank you, Natalie. So I agree with what's been said so far. I think tech is going to be one of the big themes, not only in new companies, tech-enabled companies, but also in legacy companies, which have to compete now in a world of tech. That being said, to get to your question, I think private equity remains as it always has been, which is that at the end of the day, as long as you've chosen your investment thesis correctly and you've chosen your companies correctly, what then matters from then onwards is execution. And that is what differentiates bottom quartile to top quartile companies. So that goes to having an excellent team, making sure the team has complementary skills. There is a good culture of excellence and cooperation. It goes to having proper procedures and processes. It goes to having experience, so making sure your team is there and stable, because that leads to people with more and more experience in those industries in Africa, but also with working with each other. So stability is important. And then I always say to my colleagues, it's not that we can keep problems from appearing. They will always appear. There'll be always problems in good times even, let alone bad times. It is how quickly they are identified and how quickly they are solved. And that goes back to team, processes, culture, and then back to execution. Everything from sourcing to proper due diligence to having a investment structure process which is not deviated from, and as learnings happen is added to, so it gets more granular and more fit for purpose for that time, to very strong value add operational teams. In this world, our work in impact and ESG has become front and center, because ESG is what we had to do into our companies to keep them from having COVID deaths, from operating properly, etc. So that is very important. To exits. So yes, exits, there are times when it's good, times that it's bad. It's probably not the best of times right now, but preparation for exits for maybe next year, or even we're doing exits now. We're about to exit 2 companies, but certainly next year and the year after. That's very important. So bottom line, Natalie, is execution. It's the micro part of private equity, which hasn't changed, COVID or no COVID.
Thanks, Runa. Absolutely. I think we can all take a lesson out of that book. Vuyo, if I can turn to you, I mean, obviously we've touched on COVID, but outside of the devastating human and economic impact that COVID has had across the industry and certainly across the world, are there any bright sparks or any positive outcomes or impact that COVID has had that you can see in your portfolio or within the sector?
Yeah, I mean, I think for us, it's sort of confirmed our thesis that investing in infrastructure, which is critical and plays an essential role in communities, is a good risk mitigated way of entering the private equity space. So much like Runa's portfolio, which continued to operate without interruption during COVID, I'd say almost 100% of our portfolio continued to operate. And we're talking power stations, we're talking roads, etc. All those services were deemed essential and were able to generate revenues during COVID. So beyond the proving of the thesis, I think Certainly from an infrastructure perspective, you mentioned the fact that governments have seen their coffers hollowed out. And the truth is that in Africa, even pre-COVID, a lot of governments had gone on a borrowing spree, and the debt service costs were already quite significant relative to their tax collections. I think what COVID has done is it's sort of highlighted the requirement for other forms of capital to come into the infrastructure provision space. And I think there's lots of opportunities for funds such as the ones we manage to then step into the space that government has now opened and provide efficiently delivered and well-run infrastructure for communities. And obviously, to the extent we do this well, i.e. execution, as Runa was saying, the investment returns for our clients will be good. As spoken to earlier, we think that areas such as digital infrastructure as an investment space is going to become even more attractive. It's a space we were already looking at pre-COVID, but I think the impetus to invest further in that space is going to increase as a result of COVID. I would say, though, that we need to be careful. I think the previous panel was speaking about Regulation 28 in particular in South Africa and the ability for pension funds to invest more into infrastructure and private equity. Obviously, the big risk here is that you get too much money chasing too few opportunities. You get lots of new fund managers who are inexperienced, and you could have disaster stories in such a setting. So it's important that trustees and other investors look for investment managers with experience in the space, and we don't just invest in government wish lists. We invest in projects that are sustainable and can wash their own face and are kind of cut it from a governance perspective in terms of the ESG principles on which they're based.
Vuyo, thanks. I mean, you mentioned this point around competition, and with Reg 28 coming in, that potentially there could be a flood, if that's the right word. It would be great if there's a flood from Regulation 28 into the industry. I think we'd all welcome that. But that's just to touch on this point around competition. What have you seen? So, looking at competition, particularly in the infrastructure area, from international players, and specifically, what has that impact been on valuations in the sector, and how you see that playing out from a returns perspective?
My view on it is, I think South Africa has been slightly different in the sense that it's got deep capital markets. So RAND funding has tended to be quite competitive when projects are bid. I think in the rest of the continent, maybe about a decade ago, the whole Africa Rising narrative was the dominant narrative in terms of investing in Africa. And we saw lots of large players seeking projects on the continent, and there was a swath of money chasing relatively few opportunities, which obviously had an impact on pricing. And I think you'll see that investment vintages from around that period have not really delivered on the promise, really, and sort of drive the low perceived returns from African infrastructure and private equity over the period. But I think a lot of that money has now left the system, and I think valuations are at more sustainable levels now. And I think there's definitely, both in South Africa and across the continent, lots of opportunity for that return differential between ourselves and developed markets to rear its head again.
Great to hear that, Vuyo. Jan, if I can turn to you, I mean, there is a obviously outside of COVID, which was the big topic for 2020, the other topic that was on all of our minds from a PE perspective was the blacklisting of Mauritius by the European Union. You're sitting in Mauritius, and I think this is a very big topic for many of our fund managers in the audience who have domiciled their funds out of Mauritius. I mean, give us the inside scoop here. I mean, what happened? Why was Mauritius blacklisted? And what is Mauritius doing to get themselves out of this pickle?
Okay, thank you, Natalie. So I think back in February 2020, in Mauritius, we got a shock when FATF put us on the list of jurisdiction under increased monitoring, which is also known as the grey list. And this is despite the fact that Mauritius was compliant or largely compliant on 35 out of the 40 FATF recommendations. At the time when the recommendations were there, if you score 35 out of 40, people would say, oh, that should be fine. But unfortunately, we were not aware that this was not sufficient, and we were put on that grey list. Then the EU informed us in May 2020 that they in turn will put us on the high-risk third-party list, which is also known as the blacklist of the EU, and the effective date would be 1st of October 2020. So I have to say that between May and October 2020, the Mauritian government took a lot of steps, changed a lot of laws, made a lot of on-site visits to the licensed companies, etc., and even filed a progress report to the FATF and the EU. But unfortunately, that was not sufficient, and Mauritius was put on that list on the 1st of October 2020. And I think the biggest thing that they wanted Mauritius to improve was on the technical compliance and effectiveness. So they were saying that, yes, maybe the laws are there, the institutions are here, but are you enforcing it? Is it effective? And this is what we needed to demonstrate. Okay, but I have to say that before we came into the blacklist in October 2020, a lot of people said that there would be a lot of impact, that flows of funds outside of Mauritius would happen. But to be honest, we have not seen that. The funds are still in Mauritius, and in terms of transactions, banking transactions, we see that as normal. So it takes the same time as it used to take pre-COVID. So we're not really seeing an impact on an operational perspective. Okay. So, and I think in terms of evolution, what happened is Mauritius filed another report back in November 2020. And then in January 21, there was a virtual face-to-face meeting between the FATF and the Mauritius government. And from what we understand, the FATF said that they were happy about the progress that Mauritius has done in that time. And again, in January 21, there was an SAMLAG report where Mauritius was compliant or partially compliant on 39 out of 40 recommendations. And then in February 21, FATF issued another report on Mauritius where they said that we had to improve on 5 aspects. And I think that the main one where that we had to improve is implementing a risk-based supervision plans effectively for financial services and relevant designated non-financial business and professions. So I think where Mauritius really needs to improve is on the non-financial business activities. That is on the real estate, the jewelry sector, on the gambling sector, where a lot of money is involved, but for which they deem that regulations is not sufficient. So this is where we are right now. So I think that the next step is that FATF needs to come to Mauritius for an on-site visit to confirm that whatever we said in our reports are accurate. And the problem is, because of the COVID situation, no exact date was communicated when they would come, but we expect that this would happen around June or July of this year. And assuming we get a positive feedback from the report, so first of all, we need to get out of the FATF grey list, and then the EU will recommend to get us out of the blacklist. So if I have to say when will we get out of those lists, I would say probably towards the end of 2021 or beginning of next year.
Thanks, Jan. That's great to hear. I mean, I think all of us are really rooting that Mauritius does get back to where it was, because it certainly was a big part of the certainly the sub-Saharan private equity world. Runa, in the closing remarks, I mean, when you and I were chatting earlier, you were saying, it's often quite easy to get bogged down in the kind of doom and gloom of COVID. We all kind of locked in our work from home offices. A lot of us, aren't allowed to leave our homes because of lockdowns, etc. I mean, again, just in closing remarks, where do you see the optimism? I mean, what can we be saying to ourselves to kind of go into 2021 with a spring in our step?
First of all, we should be happy that most of us are Zoom workers, because if you can work on video conference, you can keep your company going. And we should be thankful that this pandemic happened when we had video conferencing and all the other electronic manner of keeping in touch with our companies, our colleagues, etc. That has kept our industry going. And that is what has kept our industry, even innovating, because we find that because our colleagues are traveling less, they're here working on internal innovations. So there's optimism in that. Finally, I think that, if one assumes in 2022, we'll be out of lockdown, and I'm in London, which is completely restricted, that some of these pressures that our teams are feeling, because we're not, with each other, we're not with our management teams in most cases, sometimes we are, that will disappear. And we have to make sure and keep innovating how to do things on Zoom that get through some of the issues of communication, morale, etc. We've had great Zoom parties and Zoom quiz nights, and we actually talk to our CEOs more than ever before because it's so easy to get them on Zoom. So there is optimism, and the optimism starts with the fact that we are in the industry we're in, and we can use electronic means of communication.
Absolutely, and I think it's taught all of us how we can be more effective working from home without having to kind of get on planes and be away from families and friends and polluting the environment. So I think there has been some really good news that's come out of 2020. I've got a few minutes left. I'm going to just turn to the Q&A and check if there are any questions from the audience. I can't see any now. Just to remind people that you can type your questions into the live Q&A. I'll just give everybody a second or two to do that. Right, okay. Runa, I'm just going to read this because it's quite a long question. It's directed at you. It says, you note that companies reacted quickly were resilient. And I believe that in many PE cases, companies backed by PE would have been better placed through access to financial and non-financial support, such as ESG systems, to react quickly. Is there any indication that PE participation has demonstrated resilience versus peers who are not backed by PE?
Well, I have to say, I only know our portfolio well. And through our portfolio, I know the competitors of the companies. And in looking at those two things, the answer would be yes. So for our companies, we did what we called a checklist. We also made it available to the whole industry. So it's on our website. And as it got updated, it became available. And we presented it through webinars because we thought it was important for everyone early on to look at those things in an organized way. Health and safety, how to get there, protocol in that, supply chains, cash preservation. And then, as things started opening up, market share gains. If your companies didn't retrench much, then you are still in a good position to deliver when the demand comes back. And that's what we've tried to do with our companies. So compared to their competitors, they have gained market share. And those companies that are acquiring those targets are just a little bit less expensive now. So yes, it has worked. I can't give you kind of overall PE versus not PE, but these are just some observations. In terms of ESG, I think ESG is important regardless. It is one of the tenets in our firm. Every one of my colleagues and myself are trained in it. We have 2 full-time sustainability managers, and we also do impact along the lines of gender balance, job creation, enhancement, climate change, and then the SDGs as relevant to that particular company. Why did I bring it up? Because if a private equity fund is already doing that, then the questions that came up during COVID are not unusual questions. So you are going to be thinking about the social part. Governance becomes important. Environment becomes important. So if you have expertise in that, we were able to deploy that early with a different slant, the COVID slant, into our companies. But it's important at all times.
Great. Thanks, Runa. I'm a little out of time, but there's one last question in the comment box that talks to how are we managing exits around the COVID recovery. I mean, Robert, I'll give you our view on that as Actis. I mean, certainly last year, I think a lot of people kind of looked inward, and as you saw what Runa said, the first part was obviously to look at our portfolio companies. But I think what has happened coming out of COVID is that the strong have survived and they've actually got stronger. And I think going forward, companies, we're starting to see it now coming into 2021, where companies are lifting their eyes up from the internal and looking external to see how they can grow and where they can acquire. And obviously that gives us options for exit. I think the one thing that has changed is I don't think we'll ever be putting all of our DD providers on an aeroplane again. And that, I think, is what we've seen. We did manage a few exits in 2020 where pretty much all of it was done online, virtual data rooms and virtual management presentations. So from a practical perspective, I think exits will get easier from the kind of the DD side of things, just given what COVID has taught us, and Zoom and all these kind of platforms that we have. But I think going into 2021 and certainly 2022, I expect exit activity will pick up a lot as those exits that were earmarked for 2020 have been pushed into 2021, 2022, and we'll have businesses that have shored up cash potentially in through the COVID time that will have extra cash to do that. I'm going to stop there because I think I'm in extra time and I'm sitting at a coffee. I think the next one is a coffee session, so that's super important. So I'm going to hand back to Zipo to pick up the moderator.
Thank you so much, Natalie, and thank you so much for the whole panel. Even I'm sitting here inspired. I'm thinking the next thing I want to do is very quickly go and make sure that we up those investments where we can. Thank you so much for also just restoring our confidence in the region, because it's important for us to realize that even though times have been difficult, there are opportunities. It's not going to be easy, but there definitely are opportunities, and looking forward to learning more about that. So thank you again to the panel. What's going to happen next is we're going to switch over to the other room where we have an interesting and insightful speaker. So we'll see you there shortly. Thank you.